The Magnificent Seven stocks have been blowing everything else out of the water. These 7 companies are Apple, Microsoft, Meta, Tesla, Google, Nvidia, and Amazon. These 7 make up the top 7 in the S&P 500 by market cap. Over the past 5 years, the S&P 500 is up over 70%, which is very nice for investors. But let's take a look at what the Magnificent Seven has done over those last 5 years as well. Coming in at 7th place, Amazon is up 103%. Alphabet or Google is up 159%. In 5th place, we have Meta up 197%. Microsoft is next, up 260%. And now we get to the fun stuff, the top 3. In 3rd place, Apple's up 268% over the past 5 years. 2nd place is Tesla, up a crazy 881%. And number 1, we have Nvidia, up an insane 1,950% in just 5 years. Had you invested in any one of those stocks 5 years ago and are still holding today, you're sitting pretty. And actually, for those of you that have been investing for a while, comment down below if you did hold one of these early on, or what's your best stock that you've ever bought. But anyways, these companies are definitely the most fun and exciting companies within the S&P 500. They're also the most dangerous for new investors. The secret to getting very rich in the stock market is to buy stocks and ETFs when they're undervalued or at a lower price, and then eventually sell them when they do skyrocket. Right now, all these companies have been skyrocketing, and so they're pretty expensive. The thing here though is that investing is not cut and dry. It's not just about the numbers. We definitely need to consider a couple other things. In this video, I'm going to go over each one of these stocks and give you my honest assessment as to if this is a good buy or not, in my opinion. By the end, I'm going to explain how I'm investing in these and which one I think is best. And as you can see, I'm going to be changing offices, so my background looks a little different for the next couple videos, but don't you worry, I brought my little rooster along. So let's go in order from the stocks that have grown the least to the ones that have grown the most. So in 7th place was Amazon, and I'm excited about this company. The company bounced back big in 2023 and now in 2024 thanks to Amazon's focus on AI. Amazon is using AI to improve its own operations and selling AI products and services through AWS, the world's cloud service leader. Many analysts see Amazon rising huge in the next couple years. Amazon now has slimmer cost profile, which will lend to faster earnings growth in the quarters ahead. From a valuation perspective, while Amazon stock is not as cheap as it was 6 months ago, the shares still look like a bargain relative to the company's long-term potential. The current price is $175. Year to date, it's up 16.72%. In the past full year, it's up a whopping 71.48%. For each one of these stocks, we're also going to look at the PE ratio and the 5-year PEG ratio. PE is price to earnings, and that's where a lot of people stop. This is basically saying how much you as an investor will pay for $1 of the company's earnings. For example, Amazon has a PE ratio of 60.34, so for $60.34, you're getting $1 of earnings. This doesn't seem like a good deal, but in investing, it's all about the future. Obviously, an investor would want that PE ratio as low as possible. A good range is under 20, but these are all growth stocks and very exciting, so we're definitely going to see some higher PE ratios here. The other metric that we're going to look at is the PEG ratio, which I like better. The PEG ratio enhances the PE ratio by adding expected earnings growth into the calculation. The PEG ratio is considered to be an indicator of a stock's true value, and similar to the PE ratio, a lower PEG may indicate that a stock is undervalued. We want this as close to 1.0 as possible. Amazon has a 5-year expected PEG of 2.26. Amazon also just beat its earnings projections this week, so the PE and the PEG should look better in the next couple days, but the company overall is looking stronger and stronger by the day. Next up is Alphabet, or as we know it, Google. Google has an extremely solid moat or competitive advantage in the business that brings in most of its revenue, which is search. And Google Search holds more than 90% of the global search market. This has kept advertisers coming back even during recent times of higher inflation. Today, Alphabet, like many of these Magnificent Seven companies, is investing in AI, and this technology is helping it to make search faster and better. This, along with AI offerings through Google Cloud, may power earnings growth in the coming years. The current price is $164.64. Year to date, it's up almost 18%. In the past full year, it's up 52.85%. The PE ratio is 25, and the PEG ratio is 1.52, which is definitely nicer than that of Amazon. Google has such a huge competitive advantage, and it owns so many things like YouTube, which you're watching right now, and its financials and metrics are in a solid range, so I really like this stock. And since we're talking about the Magnificent Seven, I want to highlight a new promotion from the sponsor of this video, Moomoo. And for a limited time, you guys can get fractional shares of all of the Magnificent Seven that I'm going over in this video. You just need to set up an account, deposit $100, and boom, you'll receive 10 fractional shares of these amazing stocks. Moomoo is one of my favorite trading platforms. Unlike other apps, you can tap into pro-level tools and information for both beginners and advanced investors absolutely free. Now, I'm all about safety and security. Moomoo Financial is a member of the SIPC, which protects securities customers of its members up to $500,000. Moomoo also has no hidden fees, no minimum deposit required, or no account management fee. To help you find and analyze the best stocks for your portfolio, Moomoo can assist you with its easy-to-use tools. I recommend you use the heat map and heat list to discover potential opportunities. Once you've identified a stock to explore further, you can also check out their stock quote page. You're going to want to click the link down in my description to get those 10 fractional shares, or even just to take advantage of that 5.1% APY in the money market account. Either of those is a solid deal. Next up on the list is Meta, formerly known as Facebook. Facebook had been crushing it in the social media / data game for years and recently went through a total business model revamp to focus even more on AI, developing its own large language model and aiming to apply AI across its products and services. Regardless of if the metaverse ever happens, the strong push towards AI and staying one step ahead in technology is a very strong move, which is just driving a crazy amount of growth. The current price for Meta is $430.17. Year to date, it's up 24.22%. In the past full year, it's way up at 76.89%. The PE ratio is 24.74, so still low even though the price has appreciated so much in 1 year. And that PEG ratio is perfect, and it's the best so far at 1.0. Meta company numbers look very good. And the next company on this list is Microsoft. Microsoft is now the largest company in the world by market cap at worth almost $3 trillion. It's shown its ability to seize a growth opportunity and was an early believer in AI, investing $1 billion in OpenAI, the developer of ChatGPT, back in 2019. The tech powerhouse later extended the partnership and increased its investment, a move that also strengthened the company's cloud business, Azure. This business offers a wide variety of AI tools and has seen its revenue growth soar, surpassing that of rivals Amazon Web Services and Google Cloud. So Microsoft could clearly be a winner in the AI revolution. The current price is $389.33. Year to date, it's only up 4.98%, which is actually better for investors because we don't necessarily want to buy in after a big price spike. In the past full year, it's up 27.42%. The PE ratio is 33.74. and the PEG ratio is 1.99. As you know, I've been a big believer in Microsoft for quite some time, and I'm looking forward to what their strategies bring in the near future. Now, Apple is the next one. Apple's the second biggest company on our planet by market cap at about $2.6 trillion. Apple does a little bit of everything in the tech world, but most famous is the iPhone and Mac, along with wearable technology and data as well. It has some of the strongest brand loyalty from its customers out of any brand in the world. Apple does seem to be plateauing a little bit and losing a little bit of market share to competitors, so it's definitely something to look out for. The current price is $170.33. Apple's actually one of the ones that's down for the year at a negative 8.25%. In the past full year, it's been pretty flat, but as you can see, also a bit volatile with some upswings and some lows. The PE ratio is 26.45, and the PEG ratio is 2.14, which is one of the worst so far. Apple's numbers comparatively are not looking so great, but again, we don't just look at the numbers when we're analyzing a stock. Now, next up on this list is one that I've wrestled with for years. The numbers never make sense, and the CEO is kind of all over the place, but the company is one of the biggest as far as value in the entire world. Tesla surged over the past 5 years as the company delivered more and more vehicles, opened major new factories, delivered record earnings, and built up a huge pile of cash. The cash level is particularly important because it'll help this EV leader continue to innovate and potentially progress on programs such as self-driving technology. Earnings and share price performance actually have slowed in recent times as various factors weigh on the electric vehicle giant, from higher costs linked to production ramp-ups to negative foreign exchange impact. The current price for Tesla is $183.28. Year to date, it's down the most of the bunch at negative 26.22. In the past full year, it's actually up overall at 13.25%. The PE ratio is still quite high at over 46, but definitely lower than a couple years ago when it was in the triple digits. The PEG ratio is high as well at 3.43. Like I said, these numbers aren't great, and they haven't really ever been amazing, but those that have been invested in this company for quite some time, this has been a gold mine for investors. The last one on this list is the semiconductor and AI company that's taking over the world. And after this one, I'll tell you which ones I believe are buys today and which ones I hold personally. So this last company is none other than Nvidia. Today, Nvidia holds about 80% of the AI chip market, and that's not likely to change as the company invests heavily to stay ahead of rivals. This tech giant just recently announced its new Blackwell architecture and most powerful chips ever, set for release later this year. Get ready for some crazy numbers. The current price is $864.02. Year to date, it's up a whopping 79.38%. In the past full year, almost 200% growth. As you probably guessed, the PE ratio is quite high because of this rapid price appreciation this year, and that's at 72.42. But the big surprise here is the PEG ratio, which is actually one of the best out of all the stocks on this list. The PEG ratio for Nvidia is a very solid 1.18. Nvidia is definitely the hot stock this year, and it's solidified itself as the number 3 largest company in the world by market cap recently. So which of these are a buy and hold forever stock? Honestly, it's tough for me to say any stock is actually a buy and hold forever, because companies go out of business, even ones that seem too big to fail. If you've never heard of Sears, look that one up. They made the competitive advantage of something like Apple or Nvidia seem like a speck, but they eventually failed. So it can definitely happen. If I'm gonna pick an individual company to invest in, especially long term, it needs to have clear competitive advantage, it needs to be sustainable for a while, it needs to have a strong leadership team, and I just need to believe in the overall strategy they're going with. There's really only one on this list that's an absolute must for me, but on this list, the runner-ups for me are Google, Amazon, and Nvidia. The financials for all three are impressive, especially because they're tech companies, and each one has such clear competitive advantage and a moat over their nearest competitors that I think that they're going to be solid for the next 5, 10, maybe even 20 years. The absolute no for me personally is Tesla. And then personally, I just don't like the business practices of Meta or Facebook, so that's a no for me as well. I'm very much aware that Tesla and maybe even Meta could be the overall winner long term when it's all said and done, but those are easily the most volatile of the bunch and they could drop at any moment. So that number one for me is actually the number one stock in my portfolio, and it's none other than Microsoft. I really can't see them slowing down anytime soon, especially because they're the front runner in the AI revolution, and AI is only getting bigger and bigger. I do believe that all of these companies are something that we should all have a little exposure to. And so I'm happy that I do have all of them because I invest heavily in the S&P 500 and in other growth ETFs that all hold these stocks. The safest way to invest in these types of companies is through ETFs. So to see the choice I made, if I could only invest in one growth ETF forever, watch this video now. Or watch this video to continue investing and investing simplified.